Сайн байна уу? Zolo Show-ийн ээлжид дугаар хүргэж өгөхөд бэлэн болж байна. Тэгээ өнөөдрийн ярилцлага маань англи хэл дээр явагдана. Тийм болохоор би одоо англи дээр subtitle тавьчихна. Тийм болохоор subtitle дээр CC дээр дараад үзээрэй. So hello Mikael.
Hello.
Thank you for being guest at my podcast. And in the introduction, I would like to ask you for a brief origin story of yourself. Where are you from? How old are you? What's your educational background? And what do you do?
All right. I'm 48 years old now, and I'm from Sweden. I was actually born in the very north of Sweden, a place called Jukkasjärvi, where we have a famous ice hotel built every year. But pretty soon my parents moved down to more civilized places in Sweden to actually close to the capital. I studied financial economics at a business school in Stockholm, which is the capital of Sweden. And I really shouldn't have ended up there because I was always more interested in natural sciences, like mainly physics, and I still am. So I do read a lot of quantum physics and science fiction based on quantum physics. I think that's an extremely interesting area, both quantum physics and philosophy related to that. Anyway, I was bullied in school, and one of my main bullies, he really wanted to go to this business school because it's the best school in Sweden, and it's very difficult to get in. You really have to have the absolute top grades in everything. But I really wasn't interested in economics or finance at all. I just actually went there to spite him, my bully. Not recommended to choose your education based on that, but anyway, that's where I ended up. And after 4 years, so I went there 1990 to 1994. Even after those 4 years, I still really didn't understand what the financial markets were. Sure, I did a little bit of investing in stocks. But I still really didn't get the actual structure of the market or what you really were supposed to do. But having taken my graduation in '94, I ended up at a small broker firm, first as a broker's assistant, but very soon, just like after a couple of months, my employer realized that your kind of temperament, that's not being a trader or a trader's assistant. You really should be an analyst. So an analyst goes through the P&L statements, that's profit and loss statements and balance sheets, and actually try to understand what does a company do and exactly how does it create value. So what you really want to answer is the question, if I pay a certain amount for a stock, exactly how, when, and from whom am I supposed to get my money back? So, I mean, I need to get my money back in some way. So either, for example, dividends from the company or selling the stock to somebody else. And then they have the decision and problem of actually valuing what the company is really creating. Anyway, so that was I started doing that in 1994, and this was really a low tier firm, so not a good place to work at. But I didn't care, and I didn't really understand that. However, I got really lucky because somebody who did work at the same firm for a short while went on to a much better place, one of the biggest banks in Sweden, one of the 4 big ones. And shortly after that, they wanted somebody who understood technology, so consultancies and software. So they hired me. They simply gave me a good offer and said, why don't you come and work here instead, and you will be the head of the IT research department. So in 1996, that was more or less perfectly timed with the internet and information technology, that the bubble or the boom that started with let's see, Netscape's IPO in 1995, and I was hired in 1996 into this other place. So for 4 years between 1996 and year 2000, perfectly with the IT boom, I was the IT research, well, head of IT research at this big bank. But after some time around the turn of the millennium, I just felt that valuations, they are so crazy. There is no way that these companies can ever create the kind of value that we are paying for these companies. And I was also starting to grow tired of the business in general. I thought that the hours were too long, and that what I was doing was meaningless. But right there, actually more or less perfectly timed again with the absolute peak of the bubble, I accepted an offer from a hedge fund. I think I signed in February 2000, and the absolute peak of the internet bubble was in I think March 9 or something in 2000.
Oh.
And this new place, they and I were all pretty negative to the valuations on the stock market. So we started shorting, selling companies in order to profit from falling stock prices. So we started doing that.
Excuse me. Some of our listeners, they might not know what's a hedge fund. Could you explain what's a hedge fund?
Yeah, sure. So a normal stock or equity fund, that's just like a basket of various stocks, so the fund managers at normal fund, they take care of the client's money and buy and sell stocks. A hedge fund is more or less the exact same thing. It's just that the regulations allow for a much wider set of instruments and strategies. I once checked how many different hedge fund strategies there are, and there are about 1,000 actually distinct different strategies. So you can't say this is what a hedge fund is. But having said that, our hedge fund was more or less what the original hedge fund actually was when they were created back in 1950s, and that's buying stocks only, so shares in traded companies, and going both long and short. So that means that both owning companies and holding negative positions, so inverted positions in stocks, which means that if they fall, we will profit from the difference between where we sold them and where we buy them back again. So it's really shorting is just, it's exactly the same thing as buying and then selling. You just do it in the reverse order. And our hedge fund, we were not always hedged. If you're perfectly hedged, then you have as many long positions as short positions, and that would mean in theory that it doesn't matter if the stock market as a whole goes up or down. You're just trying to profit from the difference between your longs and your shorts. But we had a 3-year mandate, so we could be very long, even more long than the amount of money we had. So we could use leverage and be up to 2 times as long as the amount of money we managed. And we can also be about 100% net short, but we never really we never used that mandate on the downside. But for a while we were 60% net short, more or less entire year of 2008, which was a very good year for us. So anyways, I worked at this hedge fund between 2000 and 2015. our fund got the prize European Hedge Fund of the Decade for the years 2000 to 2009. And that was in competition with about 4,000 big European hedge funds over those 10 years. So,
wow, that's very impressive.
I mean, there's of course a lot of luck involved, and there are a lot of decisions that had to be made, and some were more lucky than others. But I think one of the things that we were lucky to get was that between 2000 and 2015, fundamentals and fundamental analysis, it still worked, because the market and valuations, they went up and down around some kind of more or less reasonable valuation. But after that, let's say starting around 2000 somewhere around 2013 maybe, then central banks started getting really crazy, just printing a lot of money, and stock markets just kept going up without the actual value creation in the companies going up in the same manner. So the last few years, so I quit the hedge fund in 2015. I actually resigned in January 2014, but I stayed on at the fund to make clients feel relaxed with that everybody was still at the fund. But during my retirement, if you will, last 5 years, I've just seen the stock market keep going up, valuations keep going up to just absolutely crazy levels. I mean, it seems as if central banks they will keep doing what they've done for a pretty long time now, and they're just printing more and more money in a faster and faster tempo. But this coronavirus situation seems to have at least put some kind of a brake on where stocks dare to go, even given all the quantitative easing. So it's an interesting situation, and it's I think that the only thing that I dare make a forecast of is that volatility is here to stay. We will see bigger and faster both rips on the upside and dips on the downside. I guess that the Mongolian stock market more or less mirrors whatever happens here or in the US. Well, if it has, you've seen the last 2 weeks how we can get 10% up days and 10% down days in Standard & Poor 500, the world's largest stock market index, and that's just completely unheard of before, at least in outside war time.
Yeah, and also what shocked me is, and also that might be a good question for you. So Italian stock market, like 2 or 3 days ago, it has risen by 16%. Like I was like flabbergasted. Like how is it possible?
Yeah, I mean it's and if you look at just individual companies that well, there are no news and they just want to go up or down by 25%, and it seems that liquidity is extremely low, and that I think that is because there's very little real money actually making any investment decisions. So there are very few people actually using fundamental research and taking positions that they really believe in. Instead, there are momentum-based strategies and like what I call stupid money in just indexed funds that don't really care what they buy. They just, if they get inflows or outflows, they just sell without discrimination. They have to offload whatever they have in their portfolio, or they have to buy the amount that they get inflow. since there is very little real money, these flows when they become outflows, I think that explains why the markets can move so much without any real new information. I mean, usually, if we look back to 2002 or 2008, for example, when we have a cyclical recession and stock markets in US or Europe, when they go down by, let's say, 50 to 60% over a couple of years, there usually are a lot of pretty steep rallies, like 10, 15, maybe even 20 tradable rallies over those 2 years, while the stock market in total goes down by maybe 50 or 60%. But this time, it seems that we get that kind of behavior in just a few weeks or months. So we get the 10% rallies that usually would take several weeks. Now we get them in one day, and then we go down again by 10% the next day. So I think the machine and index and stupid momentum funds, they create the same kind of pattern, but just compressed into a very short time frame. That makes it very difficult for ordinary people to try to keep up. And in that situation, I think it's ever more important to focus on what the actual value is, because you really have to take an informed decision and then just stick to it. And it becomes too difficult for most people to try to trade these movements.
Mm-hmm. I see. And it was similar, what you say, like sudden rallies. It was also depicted from what I remember in John Kenneth Galbraith's book, The Big Crash.
Yeah. And if you look back to, so he's talking about the crash in 1929 to 1932. And then there was a pretty calm period up until 1937 and pretty good recovery, and then the crash of 1937 as well. And I think that we could see the period between 1929 and 1937, like those 8 years. I think maybe we will see something similar within 2020, just within less than 1 year. We will see the same amplitudes.
So you've been a successful hedge fund manager for 10 years. So what's your secret?
Hold on a second. I just realized I have a low battery. So if we can just pause, it will take just a minute. Just hold on.
All right.
All right. So
the we're back. So what's the secret of running a successfully hedge fund for 10 years? What's your secret?
I think that's I was very focused on actually understanding the companies. I didn't want to trade movements, but rather find a couple of really good companies and investments that I could believe in, and then just be prepared for when I thought that the movements were unreasonable. So, for example, if I thought that, let's say, an IT company had a nice growth and a okay valuation, perhaps, then I would just keep track of everything that affects that company, and just be prepared for just single days or weeks when just something made the stock fall. So it could be like just a 1 week quarterly report, and if I thought that, well, people are misunderstanding this just because, well, 1 week quarter doesn't really mean anything in the big picture. So I would just be like prepared to jump in and buy things that just suddenly falls for no reason. However, that would definitely not be enough of a strategy to become the best hedge fund. I think in general the most important thing, that's really to control your risk levels. You should never find yourself in a situation where you have to trade emotionally. So just always be both patient in researching companies, patient in not taking so high risk that you can become a forced seller, or that your emotions run wild and you can't think straight. So what typically creates problems, that's when you feel rushed. So if you think that, oh my God, I really need to buy this company, and now it's starting to trade up, and I will have to just chase it higher, then you're already too late. You should just drop that company and move on and try to find something else. And the same thing goes for an investment that you already have. If it for some reason goes down, then you should never have too much invested, which could cause you to be stressed or think that if you find yourself in that kind of situations where you feel that you have to take action, then you have too big of a position. So the real trick is always to make sure that you are the one that can be patient and that don't have to act just because somebody else is acting. So the patience is really the absolute key for any investor. Patience and having control of your emotions. Actually, if you feel stressed or rushed over an investment, then you should just leave the screens, go out for a walk, and that shouldn't be a problem. You should never have positions that makes you not being able to leave the screens. So just take a walk, and calm down, and then go back again and see what kind of analysis and action would be the most reasonable one. So that's patience, and the maybe second most important is that you remember that I told you that there are 1,000 hedge fund strategies. That really should tell you that almost any strategy can work if it's just implemented in a systematic manner where you keep improving. And to get there, you more or less just take any strategy and keep taking notes of when and why you make an investment decision, and then you evaluate the decision afterwards, both the actual outcome and the actual quality of the decision. Were you right because you were lucky, or were you right because your analysis actually was correct? And based on what happened, based on the quality of the decision and the quality of the outcome, you should update your tactics and your strategy. So you keep updating a kind of a best practices list. Often in the beginning, the notes that you take down in order to be able to evaluate the investment afterward, those notes are usually almost completely useless when you're a beginner. But after a while, I don't know, 10, 20 investments, and then you start seeing the patterns of what kind of information you really should put down, and what's really important to evaluate afterwards. And then this is just a iterative process where you make an investment, evaluate, update your strategy, and then you just keep going round and round in that way. And after a while, you will have like a very concrete and short list of things that you must check or maybe should check before making an investment. And I think that what most people and other hedge funds, actually like professionals, their mistake is thinking that they can just rely on their original strategy without updating it, and that doesn't work, because the market is reflexive. It keeps changing, just because there are people trying to beat each other in the market. So that means that the actual market's functioning, it keeps changing, and therefore you will have to change your strategy with it. There's actually a book. It's called More Money Than God, and it's
great book.
Yeah, definitely. I mean, it runs through maybe like 6 or 7 different hedge fund strategies over the years, and it really tells you how new kinds of strategies worked in maybe 5 or 10 years, and then it was time for somebody else to find like a kind of a loophole in the market. Well, if you read that book, you really get to know how important it is to just update your strategy.
The same author, he wrote a book also on hydrofrackers.
Yeah, I haven't read that one, but I'm sure it's good. I mean, it's a really good writer, I think.
Yeah, More Money Than God. It's a really great book, and especially anyone who is interested in hedge funds can read that book to understand what is a hedge fund, and also all those explanation on different like hedge fund managers, like the manager of Tiger Fund, Stanley Druckenmiller, and all those big guys. You can learn from this book. So, what do you think? In general, what type of people or hedge funds make money?
Like these days, the absolute best hedge fund, it's Jim Simon's Renaissance Capital. And that's a model-based hedge fund where they try to find patterns, not valuations. And that's a little bit disturbing that is the absolute best hedge fund of all time, I would say. I mean, there are a couple of ones that are a lot bigger and that also have like created a lot of value for their investors, but that really don't show the same kind of impressive and consistent returns month after month. Unfortunately, there is really no way to try to copy or beat Renaissance. I mean, they are the absolute number one in this game, and to beat them, you would have to hire hundreds and hundreds of PhDs and try to find the same kind of patterns that they do, and then on top of that, you have to be even faster than they are. So that's more or less an impossible task, I would say. But what I think is coming into vogue again will be actual fundamental based long short equity hedge funds. Maybe not just long short equity, but actually asset allocating funds. So a little bit wider mandate where you can invest in commodities like agricultural commodities, wheat, corn, sugar, coffee, things like that. And stocks, and you should probably add gold as well. So I think that the best way to manage money these days would be to use 2 or 3 or maybe 4 different asset classes like that, and keep allocating between them, like For example, the absolute simplest strategy would be to have half gold and half stocks. And whenever the markets in either gold or stocks move a lot in one direction, then you keep adjusting the portfolio back to 50-50. And that kind of super simple strategy, that creates a lot better risk-reward characteristics for a portfolio than either gold would have or stocks. But I really think that the key going forward, that will be actual fundamental analysis of what the companies are actually worth. And that hasn't really worked in the last 5 years. It's been, I mean, the market has just been crazy. But I think that kind of strategy will come back into vogue now. And there are so few people and so few funds prepared for that, that I think that it will actually be pretty easy to do it and to find bargains, because people have become used to just buying momentum and buying the dips, and they don't really know how to do actual analysis.
Mm-hmm. I see. So what's the percentage of hedge funds making money and hedge funds losing money?
I really wouldn't have any idea. I mean, there are more than 10,000 hedge funds, and I think that there are about 1,000 new ones every year, and about 1,000 that actually expire and go bankrupt or just quit the business. So it's really difficult to keep track of all these funds. So I don't have any updated numbers on how many are profitable, but my expectations, and I think that most research shows that they really don't add much value at all. So it's just like an average of the market, more or less. Pretty boring answer, but there are so many wanting in on this business, and I mean, it can be very lucrative. You can earn a lot of money in it, so it just attracts so many that's the average of the hedge funds. It doesn't really add any value, so it's just like an average investor, I would say.
Mm-hmm. I see. And also, like recently in Mongolia, there are lots of Forex trading courses that say you can get rich regardless of your English knowledge, educational level, and experience, that you can quickly learn and start to make money or make a return on your investment. So what do you think about that? What's your opinion on that?
Well, the longer a bull market runs, the easier it gets to trick people into thinking that it's easy to make money. And I think that this sudden downturn here in the wake of the COVID virus, I think that will expose a lot of pyramid schemes and bad actors simply in the market. So you will, unfortunately, people who have already been tricked, this downturn is what will actually show which things were real and which were scams. So I expect pretty soon to start seeing news about collapsing pyramid schemes. Unfortunately, I mean, since most people are not educated in how to analyze things for real, I mean, most people don't even actually know that there is such a thing, that you can do that kind of research. So they just think that the market is some kind of a game, like almost like a casino. You buy things and you hope that they go up, and you don't really know what's behind it. And because of that, it's much easier to fall prey to those kind of scams. So I think that I mean, I really think that there should be some kind of a investment class or something like that in school. It should be mandatory. I mean, rather than just teaching mathematics or just like cold mathematics or social sciences or things like that, I think you should take the opportunity when you actually have the students in class to teach them investing and teach analysis of companies and of values, because I think that would make it easier to actually learn, for example, mathematics, because it's much more interesting, and you know that there's actually a practical use for it, and that would make people more prepared for not falling for these scams. Mm-hmm. I mean, just if somebody says it's easy, or that they promise 20% returns every year, and it seems like there's no risk, then I mean, those kind of investment opportunities, they really don't exist. So if it sounds too good to be true, it usually is, and that's where you really need to go to the actual numbers and see, okay, so how is this value supposed to be created? You can't just take the sales guy's numbers at face value. You have to look at the actual officially reported statements of profits and loss and balance sheet.
I see. So question for you. So let's say you are 24 years old, a fresh graduate with $1,000 in savings. What would you do with that money and why? And just assuming you have your current knowledge.
Given how the markets are doing right now, I would put most of it actually in gold. Probably not physical gold, because it can be difficult to store in a good way. But you could buy some kind of an exchange traded fund, an ETF, with that is backed by the actual same amount of physical gold. And that is really key. It can't just be some kind of a bank certificate that promises the same return as gold, because then they don't actually have the gold, and that would be a risk. So the largest one, it's called a GLD, and that's trading in the US. That's actually backed by physical gold. And there's one called Fizz as well, PHYS, and there are a couple of ones in Europe. It maybe sounds boring to just own gold or maybe gold mines, like Newmont Mining, one of the world's largest gold mines. But I really think that we will be going through a period here with extreme volatility and a bias on the downside. So I just want to be protected against whatever the central banks and politicians are doing, because they will print a lot of money and try to save the economy and try to save the stock market. But I think that's it's too late for that, and their money printing will instead cause the price of precious metals like gold to keep rising over the next several years. And maybe they will manage to get the stock market up as well, but I think gold will go up more than stocks. But after a while, when the markets has reached a low enough level relative to gold, so it's a question of the relative prices. So if gold is trading at 1,500 now, and let's say that the stock market, just for simplicity, is also trading at 1,500, then I expect that maybe sometime in a couple of years, gold will be at 3,000, and the stock market, I mean, it could still be at 1,500, or it could go up maybe to 2,000, or maybe even go down to 1,000. But the important thing is that I think gold will rise more than whatever the stock market is doing, and that means that in a couple of years' time, you can exchange your gold for more units of the stock market, because that really should be the goal, the end goal in the end. You want to own stocks because those represent companies, and companies are growing and are a part of the economy, and that's where the value is created. And gold is not creating any value. It's just like a parking space and an insurance. So what I want to do over very long periods of time is that I first own gold, and then when the relative prices towards stocks have changed, then I switch the gold into stocks. And then I keep my positions like that for a long time, and then sometime in the future, then probably gold has become cheap relative to stocks again, and then I switch back to gold, and I keep going back and forth like that over like 10 and 20 year periods. Maybe it's a little bit of a difficult strategy for somebody who's not familiar with these and don't really know what they're doing. But what you could do is, for example, use half of your money for gold and half for stocks, and then once every year or once every something. If there are large relative movements within a year, then you just keep realigning back to 50-50, and keep doing that until the stock market has calmed down a little bit, and then you could go all in on stocks.
I see. And my last question is like, what are your 3 best books on personal finance and investing that you would recommend?
I think that, well, we mentioned More Money Than God. That doesn't really teach you how to buy and sell stocks and evaluate them, but it's a very good book from a psychological standpoint. And then we have The Most Important Thing by Howard Marks. It goes through, I think it's 12 or maybe 19 most important things, maybe even a little bit more, something like that, at least in their order of around 20. And it's also mostly a psychological view on how to do investing, but it really tells you how to manage risk, what risk actually is, and how to think about your investments. You know that I wrote a book about my time at Futuris. It's called the Retarded Hedge Fund Manager, and what I do in that PDF, which is for free, it's 150 pages, and I go through all the 69 important investment decisions we made over 15 years, and I also explain all the lessons that I learned. It's 50 different lessons, and then I distill those into 12 separate, what would you call it? Well, 12 type of rules, and those are also then grouped in 4 kind of like super psychological traits or lessons. So I actually think that my book is it's very telling how it actually feels to live with a portfolio and live with making these investments in real time. So it's a really candid and open explanation of everything we made right and everything we made wrong, and in a chronological order. So I really think you could read that. And I've also written a book which is only about like 60 pages, which is an even more focused way of talking about the lessons that I learned. It's called TAOS, The Art of Sprezzatura. If you don't have it, I can send it to you. But let's see, it'll be a little bit more serious about actual other people's books. I'm trying to think of something that's more instructive in how to actually make the research. I really don't think that the mathematics and the accounting side of investing, that's actually the easiest part. It is the psychological game that's a difficult one, and that you really need to master. And I think the most important thing by Howard Marks probably is the best one. Yeah, I can't really think of any other books right now.
Yes, so you got it. It's More Money Than God and Howard Marks, The Most Important Thing, and Retarded Hedge Fund Manager of the Decade. Your book.
Yeah.
Brilliant. And Karl-Mikael, I would really say thank you for talking with me and sharing with all your knowledge. Thank you very much. I wish you all the best, and I hope you will soon get well with your fever.
Yeah, all right. Thanks a lot. Yeah, I think I'm more or less cured already.